Everybody, welcome to Jay's Corner. It is January 11th, noon Eastern Time. We're going to be an hour at most. Everybody knows that we got triple header on NFL at 1. Okay, we'll go quickly here. So, my name is J.O. For those who don't know, be sure to subscribe to Jay's Corner, which is jo.substack.com. The text in the link is in the text below the video. There's a paid version. I'm going to have a very nice announcement in just a couple of moments about an additional feature that I've just created for paid subscribers. So we're going to go quickly. Like I said, be sure in the text below the video is this tax guide. What it is it's a table coming from a carrier which basically summarizes the amounts that you can contribute to IRAs, for example, as well as the different tax brackets and the tax rates that apply. So important because it is not only the money that you have, but it's the money that you can actually use. That should improve the sound. The new feature here for paid subscribers to Jay's Corner is I realized that on the broadcasts as well as on the newsletter itself is a very wide variety of topics. It's why I ask people to subscribe and hit the notification bell. Please do that now because each topic is complicated. And unfortunately, in my view, as a certified financial planner, I don't agree with a lot of the material that we see, whether that be in video, whether that be in print. 10-minute video to just fully describe Medicare is just insufficient. 10 minutes to describe the equity risk premium is just not sufficient, or universal life, just not sufficient. To make it more complicated is the fact that there are interactions with other topics that you may not think are related. They are. Health insurance being absolutely at the center point, the connection point, the intersection, if you will. And the amount of money involved for people, everyday people, and by everyday people, I mean non-financial professionals and even financial professionals. I've been a presenter to other certified financial planners as well as investment advisors, that these financial differences are so large that they can change the decision making itself, the trajectory, the timing. You want to retire early. You feel like you have to keep working. That entire decision tree can be altered if you understand the interaction. And I'm not saying it's not all bad. There's also tremendous opportunity. The new feature here is that in these segments, for example, if you take a look at the bottom of this, you'll see a ton of different topics here. Lots of different topics. Well, now for paid subscribers, these now have been converted into papers that you can read. So I've spent a great deal of time over the last couple of segments talking about MicroStrategy and Bitcoin and what in fact is going on. And now you have here an explanation. And you can see, and this goes from the simple, meaning the three-legged stool, that is a commonly known phrase for retirement planning purposes, to more technical points. For example, here we'll get into higher interest rates and then more complicated ones when we're talking about sequence risk when it comes to retirement planning, financial planning. So important because it frames information that you need to have in order to create a financial plan. So that enough stuff aside, be sure to go to jo.substack.com. You can check it out, the free version, before deciding. But I try to add this information that doesn't exist in other locations in a cohesive way. Part of the problem that you have is that you're getting information in fragments. without a singular voice, a set of principles that kind of attach these different ideas which are actually related, whether you knew it or not. If we go back here, what we've got is, let's just get right back to the agenda here. So what we have here today is healthcare cost planning. This mentioned here about my appearances on MSN.com. So whether that be Medicare related to my book Maximize Your Medicare, or more importantly to the other set of the other generations, including my generation, right? Which is that on MSN.com, you see me talking about, and on my name here, you'll see a number of different links, topics. I just put my name and MSN. You'll also find me on thestreet.com, very, very frequently contributing to those locations, short 5 to 7 minute videos about a specific topic. Okay. All that aside, part of the reason for that is that healthcare cost planning, because the number is so big. And what we have here is that premiums have increased a lot. There's still flexibility here. So very briefly here, the deadlines here mean that you can still change. You may have not understood that your premiums have changed. You may not understood your networks have changed in most locations, right? The enrollment window is still open. I can't do anything about January. Time is running out quickly, but it's still possible to change for February and the rest of the year. To include, for example, let's say you've changed jobs, that your advanced premium tax credit, which is the subsidy to lower your health insurance premiums and possibly lower your deductible and out-of-pocket maximum, can also be modified. And the reason that it's important here, and the reason I start with health, is two. There are two reasons. Number one is it sets the baseline for financial decisions. And what I mean by that is you're Mr. Perfect, you're 59. You've got a plan for a long period of time. Your 58-year-old Miss Sick-a-Lot, whose female relatives have passed away prematurely as a result of breast cancer. So while the survivability, of course, has improved a lot, the fact is that you're not average, in which case your horizon timing is different. From Social Security claiming to investment strategy, all different from a single piece of information, which is your overall health. And then what measures you can take to control your overall costs. The link to investment strategy, which we'll get to in about 15 minutes, is the fact that overall cost control is the vital impact, the vital first question. When someone asks me, am I okay? What do you think about my financial status? My first question is, tell me how much your cost of living is going to be. How much do you use? What do you want to spend? From there, we work backwards to see if all the other pieces fit, whether that be your job's income, your retirement, your savings plan and investment plan and strategy then fit. Not the other way around. I can't stress this enough. Too frequently, the information comes to you to say, okay, well, here's my job and here's my 401k balance, and then you work from there. Rather, I would start on the other end, which is tell me how much stuff is going to cost first. And from there, then I can say, okay, what modifications, if any, and maybe it's, okay, why are we still working? So in other words, it's not always negative, and I don't want to present it that way. It's not. I don't have the idea that we have a retirement crisis. I do have the idea that we have a huge knowledge crisis. Related to overall costs is the tragedy in California. And first of all, my empathy to the entire area and no, I don't think this is the time to start throwing politically laced mud balls in any direction, right? I'm not a scientist. I'm not sure if any political party would have been able to solve, 80-mile-an-hour winds blowing fire around. But I want to point out the fact that this is going to, if it were not already clear to you, and it probably has been, that this does affect your cost of living. And from there, you can see it here. That when I'm thinking about people's, financial status here, whatever their I'm looking at expenses, and you can see here Mr. X. And this is basically a template that I'm thinking through. Okay, what are the things that we can and cannot control to try and nail down, right? You know how much food's going to cost. You know how much the mobile bill is. You know how much YouTube TV is. Used to be a bargain. It's not a bargain anymore, I promise. So anyway, here we go, right? Which is that, and now you can also understand why I talk about interest expense, why it's highlighted here, right? Which is that interest rates are higher. We'll talk about it and its effect on everything. But my point here is that I'm trying to also push down costs. It is not income necessarily. For me, this is about net income, net of expenses. And here's this article is not new. This is an article, you can see it. It was at the end of last year. That insurance and tax costs now cost more than mortgages for many homeowners. And now you can see the input here to how in fuchsia. Is it fuchsia? I think it's fuchsia. That what we have here is we have got a situation where now you've got these different cost inputs that can rise. And I will talk about it briefly here, which is that, the fact is that people don't know how insurance works. They don't. But in California, while I am not a property and casualty person, right? Homeowners, auto insurance are different versions of property and casualty. What we have here is this situation where in California, what they have is basically the sellers not wanting to sell. They don't want to sell homeowners insurance, candidly speaking. Right? We've had many high-profile sellers pull out of the market for those people who want to renew and may have canceled existing policies. To that degree, they've been concerned. Sellers are not necessarily involved in selling lotto tickets. That's not what insurance companies do. The issue is in California, they've got something called FAIR, which is the state basically insurer of last resort. The fires are so big that this is not getting enough attention, which is if it runs out of money to pay claims, private insurers and their customers will be responsible. And that is not limited to California. Because you can see here that the FAIR plan will charge private insurers proportionally to their market share in California. And now you can understand what the sellers did. They don't want to be on the hook proportional to their market share. If they have too big a market share and this runs out of money, they're on the hook for what else? And then insurance companies can pass the cost on to their policy owners. This means you live in Kansas you can know that everywhere, nationwide, that this type of insurance is rising and has already risen in many locations. I can tell you as the, you know, person with an office that has to purchase property and casualty insurance, absolutely positively the case. So you can see here these, and this is me just running Google, right, on what happens to California. That in fact you've got this last resort option who need hazard insurance. This is not news to those persons affected by hurricanes in Florida, where flood insurance has been very difficult to purchase, a topic we have discussed before. So, as a result of that, what we have is this insurance affecting the costs here. And for that reason, right, we cannot just run these calculations and now all of a sudden this future here, right, now has to be reassumed. In other words, what you thought was good 5 years ago as your assumptions now all of a sudden have to be recalculated. That is why I tell people, yes, we can establish a baseline here. We can establish a baseline to how these numbers fit together. That said, this is not a static exercise. I can't stress that enough. This is not, okay, well, I'm 63. I figured it all out. We can retire. We're done. No, not really, because this is something that you got given to you for reasons beyond your control, right? And this needs to be taken into account to some degree without also, you can't lose sleep over something with a probability of, 0.1%. I didn't say that you would be Chicken Little. No. That said, we are here today. And this is the case, as stated here, as this incredible tragedy in California ripples the area, and we hope for the safety and hopefully that the fires die down. Okay. We're going to use the rest of the time, about the next 25 minutes here, talking about the reason for me more frequently posting here. It's not only because of YouTube running the world, but as a person who originally started in the bond market, one of the main slogans to Jay's Corner is stocks for show, bonds for dough. For newcomers here, what this means is it relates to what I'm saying here, which is I'm trying to deal with expenses and trying to make sure that people understand expenses, of which healthcare cost planning is a huge input. Huge. In a related way, in a very directly related way, the cost of money is in interest rates. The cost of money is in interest rates. So when I say stocks for show, bonds for dough, what I really, it's, my, putt for, dry for show, putt for dough analogy. What it really is that you want to understand stuff and outcomes, you need to understand how the cost of money work. The end. When it comes to, that's true when it comes to here. And you can see interest expense here. And now what does that mean? That means cost of money. What does that mean? Credit card debt, mortgage debt. Right? You want to buy a house, you aspire to buy a house. Okay, now your interest rate is now 7%. And if you bought a home with the anticipation that you'd be able to refinance at much, much lower, well, you need to understand what is going on where? Here. Mortgage rates have the baseline set from the interest rate market, the bond market. And for that reason, I've only scratched the surface on the number of reasons why We're going to get into more. Every layer, there's a reason that I start with stocks for show, bonds for dough. Many reasons. Almost an entire newsletter's reasons. I have spoken about this before, right? When it comes to cost of money, we are also now talking about inflation. And you can see this video here. I'll put it into the chat. So it's here. This video here was done, 2 years ago? And this is me on a 2 years ago, I got asked a question, blindsided by my friend, Hall of Fame radio show host Art Lewis, and he asked me about inflation. And let's just see what I said. Let's see if I got it right. Or immune, or basically addicted to low interest rates, and that permeates every financial decision, every price we pay, and whether or not we're fully prepared for notably higher borrowing rates and the effect that has on everyday consumers. I think that it's probably still not fully realized. What most of you don't know is I've spent time in 3 continents on fixed income markets, directly dealing with interest rates with the largest global investors. My specific instrument has to do with that payout diagram that you see everywhere here on Jay's Corner and throughout the newsletter. I'm analyzing whether or not your payout structure for benefits is worth the money that you will have to pay for that protection. It just so happens the protection that my book deals with is the protection if you incur healthcare costs.
Hi, we're back with you. We're chatting with...
So you can see it here, right? Which is that I talked about inflation and interest rates as the starting point, which should jive exactly with how much does stuff cost. Now you can see the connection points. When it comes to the bond market, we need to be careful because this is happening around the planet. That the United States we do not live in isolation, right? This is not when I'm 0 years old, where the U.S. dominate. It is still the largest. That doesn't mean that its influence is as large as it was. This is just demographic fact. Remember, 1.7 billion Chinese, 1.4 billion Indian, right? Not Native American, India, right? And in India, most stunningly, the median age is 29, 28 years old. So what we have here is you can see this chart here, which is this is a phenomenon which is happening around the planet. And what is done, it's raising interest rates and mortgage rates along, which are, again, used, the reference point being the interest rate market, that the United States not necessarily entirely in control here, right? Meaning that there are multiple interest rates around the planet. And the other guy, meaning global investors, are looking around the planet. And if they don't want to buy U.S. bonds, U.S. government bonds, the interest rate has to keep going higher in order to attract the buyer. And this is what you have. In other words, you can hear the phrase buyer's strike. You could say there's buyer's strike, and very stunningly, maybe even most notably, is you can see that now even Japan, much higher interest rates. Now, equity markets have not reacted kindly. And you can see it down here. And this is a very nice article in the Wall Street Journal. It's for subscribers only. But you can see here, which is, again, stocks for show, bonds for dough, which is the global investor is allocating a single unit, 100 units of whatever currency that they have. So now you're, Mr. Schroeder in Germany, you have €100. You're looking around the planet of where can I get the most return in euro. In euro. Well, now all of a sudden, your euro's not worth as much as it was a year ago. It's worth 10% less. So now you're allocating in a very complicated, difficult situation, because now it's not just 100 units, it's a trillion units. And now you can see it, that what has happened here is that now they're scouring the planet, and this can also be your 401k, where global investors are looking around and going, am I being paid enough in order to take risk in the stock market? When I can get, in this particular graph, a 5-year treasury yield at the 4%, 4.57, you can see it here. And in this comparison, as this number declines, right, as this graph where these two lines converge, you can see them converging. As the lines converge, it's telling people, hey, I can get similar type of return without taking equity risk, stock market risk. So why am I taking my fixed number, 100 units, and allocating it towards the stock market? This, you can see that while it was wide, that was true then, and now you can see, and you can see here, this is now the S&P 500. So I'm going to turn off this comparison here, and what you actually see, this is SPY, which is the ETF, which represents the S&P 500. And you can see here that now, year to date, minus 1.3%. And over the past month, minus 4%. No, gone is the euphoria, the post-election euphoria, right? And as I've stated to longtime readers, right, the resident of the White House is not the top of the list affecting financial markets returns. Sorry, it's not. Party hasn't mattered. The U.S. superiority has been because of its creativity, its ability to support people and companies that have excelled, not because of the identity or party of the legislative branch. Sorry, just not the case. 4% in a month is a notable amount, right? And so now we've got to think. And the reason I say that you don't just set it and forget it, ever. I didn't say you have to watch every 5 minutes as an everyday person. No, that's what the high frequency traders are always doing. That's what the people who trade for a living, okay, that is what they are doing. Everyday people, though, do need to understand this dynamic here, because it tells you something about the way that the influential big amounts of money are allocating the money. The CalPERS of the world, Norway Oil Fund. Because when they're doing so and they're looking at this, they're looking at the same and things around the clock and around the planet. And that's kind of why I said, look, you can't just think about the United States in isolation. We have a global economy. We have global interest rates. We have global alternatives. The point being here is that when this type of thing happens, you need to think, and you can see here, this is your TDF, which sits as the default position in many 401ks. That even on a diversified basis, you see 1% minus for the year. Now, 1%, well within a range, right? That in and of itself, this statistic means almost nothing, to be candid with you. No. We've had 2 years of 20% up in a row, right? That was the uncommon.